Good afternoon, everybody. We made it. Friday is here. Just a few more trading hours, and then we get the weekend. And what a week it has been so far. Um, Markets just really have been resilient, hanging in there. All-time highs once again. S&Ps right now are up 25 points at the moment. We've got the Dow up. Let's see, what are we up? Just about 40 points or so. And we've got the NASDAQ up 150 points. Again, resilient market, especially in the face of interest rates really popping higher this week. That 10-year, which just a few weeks ago, before the Fed made their announcement about lowering rates, 10-year was trading around 3.65%. At the beginning of this week, it was 4%. Went up to 4.1%. That's a huge move. It's down a little bit from there, but to see the equity markets rally as interest rates are moving higher, boy, oh boy, that is really, that's something we don't normally see. Let me see. John, I think it might be on your end. I'm pretty sure it's coming through. Can anybody else give us some feedback here about the audio? Because I see it coming through really clearly, and I think my team does as well. So hey Francisco, how you doing? Can everybody hear me okay? Audio's good? Okay. Thank you, everybody. Yeah, John, I think that's on your end. Maybe you just need to adjust your speakers. Okay. So, what do we have here today? Before we get into the topic of the day, which, by the way, that was something that I forget who it was, something that someone suggested earlier in the week. Can we talk about hard to borrow, which we're going to do? And I always want to take your suggestions, so please let us know what your suggestions are. But before we do that, I want to show you a couple things that hit the tape today, which, I don't want to say they're outliers, but boy, oh boy, Amazon is one of them. If we look at Amazon, and we are going to look to March, look at this right here, guys. Let me blow this up. March 220 calls, opening position here today. Massive, massive buy on those. Okay, someone taking a huge open position on Amazon March 220 calls. The next one I want to look at, and boy, I don't know who wants to tie up their money for this long. I know I sure wouldn't. I'd find a different way to do this. But in NVIDIA, okay, we're going to look at some long-term calls. And no, these aren't calls going into next year. And these aren't calls going into 2026. These are calls going all the way out to January of 2027. Look at these 135s. 9,200 of those today. You're talking about $47 options. Right? So each one of those is $4,700, and over 9,000 of those were bought today. Someone's pretty bullish in NVIDIA. Okay? Don't know if it's a hedge against a different position somewhere or what, but does everybody see that? Pretty incredible to go out that far, just over 2 years, to have that capital tied up like that for so long. But it is what it is. I'm reporting the paper flow as I see it. So just want to let everybody know that. Now, we're only 2 weeks away from the election. Okay, right? I think 2.5 weeks away from the election. Kind of hard to believe that. We've kind of had this countdown, what seems like forever and ever and ever. And the VIX, which we have seen that inversion for quite a while, it's gone. Let me pull this up here. It is gone. The VIX curve is now flat. Excuse me. Let's bring this in here. Come on, where are we? There we go. All right. Here is our VIX futures. We have not seen this flat in quite some time. Okay, there is, in my estimation, there is just no, I don't want to use the word panic. There is just a lot of complacency out there with everything going on in the world. The elections here, geopolitical events, the Fed, interest rates. There's no panic out there. There's no concern, it seems like, out there. And as a reflection of that, we're seeing the market still continue to grind higher and grind higher and grind higher. Okay, but remember what we had seen over the last 6 months leading up to the election is we had seen a curve look like that with VIX higher right coming into the election. That's gone now, guys. That is gone. It doesn't mean more people are on the sidelines, Bobby. Not at all. It just means it's a risk on, for the most part, environment. VIX is still historically a little bit elevated at 18. Okay, long-term average in VIX is about 16. We're used to seeing it over the last few years down at 12, 13 levels. So 18 is still a little bit elevated, but again, with everything that is out there before us, I would expect the VIX to be trading higher. Okay, but it's not. It's not. All right, everybody, let's talk about hard to borrow. Does anybody out here actually know what hard to borrow means? And why we need to understand it, most importantly, right? It's okay to, if there's something going on in the marketplace, maybe we understand it, maybe we don't understand it. But when we find something that truly impacts the way we trade, we need to understand it. So who knows what hard to borrow is? And actually, I'm going to post up a link right here because I actually did this video that the SIBO had put out a while ago. And you guys can read this later on. Watch this later on. It's like a 7 or 8 minute video. I did this a few months ago, actually, when DJT was hard to borrow. Okay, I just threw that link up there, so feel free, don't watch it now, feel free to watch it later. I think it gives a pretty good explanation. Okay, so hard to borrow, high risk, it is hard to borrow cash to buy it. Okay, hard to borrow, Robert says, hard to get the stock from the clearinghouse to short sell. Okay, Bobby, same thing. And yeah, that's right. And what it all comes down to, guys, is the simple economic principle of supply and demand. What do I mean by that? When we're talking about a stock like Apple, Nvidia, any of the big guys that are out there, you never even have to think about hard to borrow because there is so much stock out there in the world. There are so many outstanding shares that it's no problem to sell the stock or sell it short. Does everybody know what selling it short means? Does everybody know what the word short means? Okay, short means you're actually selling something that you don't own. And that can be a complicated kind of principle to really think about, to grasp, to put your head around is, how can I sell something that I don't own, right? So when you're talking about stock, what you're really doing, and let's we could take any stock we want. Let's say you just think Nvidia is going lower, you want to sell the stock, okay? But what if you don't already own it to sell it? How can you sell that stock that you don't own? Well, whatever brokerage firm you clear through, okay, whether TD Ameritrade, Schwab, whatever it is, they are actually going to loan that stock to you. Exactly, Herbert. You're borrowing. You're borrowing that stock from them. But if we're talking about a stock like I said, like a Nvidia, an Apple, a Microsoft, the big cap stocks that have so much outstanding shares out there, no big deal. Your brokerage firm can, has that stock. They can lend it to you. You can sell it. Okay. Now you obviously have the risk if you're selling something short. If the stock moves against you, that's not a good thing. But from a borrowing standpoint, no issue. No issue. Okay? It's all about open interest, outstanding number of shares, supply and demand. However, and remember, there are a finite amount of shares out there. Okay? It's almost not like the government that can keep printing dollars more and more and more and more and more, right? There are only a finite number of shares out there on any particular stock. Once the number of those shares starts to, get close to running out, your broker will normally post something on their website or on the platform with an HTB designation. Okay? And what that means, what that does, is it alerts account holders that if you want to sell that stock short, your order could be refused, or they're going to charge you. They're going to charge you an additional fee, an additional margin requirement, because they have to go out and get the shares somewhere. They're not going to do it at, just out of the kindness of their heart. They're going to do it because they have to go out and borrow somewhere. And they're going to pass that fee and then some on to you. Okay, so remember, shorting means you're borrowing from someone. In this case, you're borrowing from a broker. Okay, now, we're going to get into these hard to borrow costs in a moment. But some of the reasons that you either may not be able to sell a stock short or may be charged a good sum for it, limited supply of the stock, there could be really high market volatility. We've seen that. Okay? Or there's just, for whatever reason, that supply and demand is way out of balance and there are way too many sellers in the marketplace. But most of the time it happens because there's a scarcity of available shares of stock out there. Okay? Does everybody understand that so far? Okay, so now, what is a different way to express a bearish interest? If I don't want to sell a stock outright, but I'm really bearish in a particular stock, what can I do? You can buy puts. You can buy puts. Exactly. And typically, for 95+% of the time, when you go into whatever stock you're looking to trade, okay, there is something called put call parity. And I'm actually going to bring in a Word doc up here that I'll be happy to post up for everybody. And let's just change the font here a little bit. Does everybody know what put call parity is? Does everybody know what that is? Selling calls works also to have a bearish position, but selling calls, you have unlimited risk. So if you try and just sell a naked call your brokerage firm is going to charge you an incredible amount of margin because you have unlimited risk. If you buy a put on the other side, your risk is limited to the amount that you pay for that put. Okay, so put call parity means that the value of the call should be equal to the value of the put. How do we express value? How do we express value? The value is expressed by the amount of extrinsic value that is priced into the option. So when things are fairly priced, the amount of extrinsic value or premium in a call option should be the same as it is in the put option. Okay, now we do have to think about things like interest rates and dividends, which do play a factor in that. But when we look for at the money options, okay, we should see the same amount of premium in a call and a put. So let's take a look at an example. Let's bring up NVIDIA here, okay, since we're talking about it. And let's go to the stock is trading 138. Okay, it's trading 138.24. Okay, and actually, rather than looking at November, because I don't even want to take interest rates into account, let's look at next week's option. It'll give us a much better example here. So the stock is trading 138.27. Okay, if we focus in on these 138 strike options, call and the put, okay, we see the call is slightly more expensive than the put. In this case with NVIDIA right now, the reason why is because the stock is not trading right at 138. It's trading higher than that, so those calls should be a little bit higher than the puts. Does that make sense to everybody? If we were trading right at 138, literally right at the money, we would see basically an equivalent price between calls and puts. I'm trying to find a stock right now. I'm just scanning through this live as we're going through this. I'm trying to find a stock which literally is right at the money here. Let's look at JP Morgan. JP Morgan's trading 225. Okay, now it's 224.90. Of course, it just slipped away a little bit here, but here we go. So JP Morgan is just pennies away from being right at the money here. If we look at the 225 calls and puts, okay, we can see that they are relatively the same. Okay, there's a little bit of an interest rate factor in there. There's a little bit of time which accounts for that, but they're relatively the same. Now, JP Morgan, NVIDIA, the other stocks we've talked about, they're not hard to borrow. You want to short them, go ahead and short them. You know, your clearing firm can easily get that stock for you. Okay? But what happens in a hard to borrow situation? Okay? If your brokerage firm does not have the stock to lend to you, they have to go out and get it. They literally have to go out and get it somewhere. And they're going to pay a fee to go get it. They are going to pay a fee to get it so they can lend it to you. Does that make sense? Again, as I mentioned earlier, they're not going to lend it to you out of the goodness of their hearts, right? They are going to make money. They're going to get charged to get the stock from someone else. They're borrowing it from someone else. they're going to then charge you more to lend it to you. They will then pass this fee and then some on to you. So let's take a look here. Oh, thank you, Leif. Appreciate it. Let's take a look. I was looking for some stocks earlier that are hard to borrow where there's a big disconnect in put call parity. One of them is Cassava Sciences. So let's pull this up here. Okay, stock is trading basically 29. Let me find an expiration with 29 strike options here. Let's go, there we go. Okay, so take a look here. Stock is trading 29, okay? The 29 strike call and put should be relatively the same. Okay, they should be relatively the same. But we can see here the put is priced much more expensively than the call is. There's about a, what is that, about a 25% premium actually in the put price to the call price. Does everybody see that? Now that has nothing to do with market sentiment. That has nothing to do with implied volatility. When I say it has nothing to do with market sentiment, meaning, boy, everybody thinks the stock's going to go down, so the puts are priced more expensively. Doesn't work that way. Okay? The reason why the puts are so much more expensive than the calls here is because if you were to go sell SAVA stock outright to get a bearish position, you would have to borrow that stock from your brokerage firm. They don't have enough of the stock to lend to you, so they have to go out, get it, then lend it to you. They're going to make money on that. So they are going to charge you, okay, they are going to charge you a fee. Well, we can see here, if we just think about that relationship of put-call parity, where the amount of extrinsic value should be almost identical in the call and a put at the same strike. Okay, it's not here. There's about a, 80-cent difference here. Okay, there's about an 80-cent difference on a $4 wide, or excuse me, a $4 priced option. If we look at 80 cents on a $4 product, okay, that's 20%. That is 20%. It is not, Francisco, I already made that point. It is not due to market sentiment. Has nothing to do with market sentiment. Okay? Do you see that the fact that this put is trading 80 cents higher, according to put call parity, than the call is? So 80 cents on a $4 wide option is roughly 20%. There is a 20% premium in the put because you can't sell the stock. Or if you do sell the stock, you are going to pay a premium to your brokerage firm. Does that make sense to everybody? Now, what is that premium? Okay, what is that premium? And does this make sense? Okay, so let's do a little bit of math here. Okay, we have a 20% premium in the puts for basically 1 month. right? These are options that expire in 1 month. Okay? That 20%, so if we take 20%, which is annualized, and divide that by 12, okay, that's about what? 1.7, 1.8% that they're actually charging you. Because they're charging you that 80 cents for just a 1 month period. What that effectively does, again, if we were to compare that to taking a bearish position and selling the stock outright, if you were to sell it at 29, your effective amount of credit that your brokerage firm is going to give you is not 29. Because of the hard to borrow rate on that, it's going to be more like 28.20 or so. That same 80-cent premium. Does that make sense? Does that make sense? That is the efficiency in the market. Calls and puts are always going to be priced appropriately, guys. The markets are efficient. So when you see something misaligned like this, it's not because the market doesn't have the right prices. In this case, it's because this particular stock is hard to borrow and you're getting charged from your brokerage firm. Put call parity is essential to understand. And in fact, we're running out of a little time. Monday, I'm going to go take a deeper dive with everybody into put call parity and the equation so we could figure out if something is mispriced or not. I'm going to do that on Monday. Bobby, should we avoid hard to borrow stocks? Absolutely not. No reason to avoid them. You just need to understand why the options may not be priced the way you think that they should be. There's no reason to avoid them, but you need to understand why the pricing is what it is, why the calls are going to be cheaper than the puts, or vice versa. When we're finished, whether it's now or over the weekend, over a beer, whatever it is, guys, I really want you to take a look. I think it's a 7 or 8 minute video. I really want you to take a look at what I put in this video, because when I did this, this was when DJT was going nuts. And this was when DJT was hard to borrow. And it was a much greater interest rate that you were being charged to short the stock than what we were just looking here in Sava. Okay, and then give me some feedback if you have any questions about hard to borrow. Okay? Hopefully this helped, guys. And again, the reason why I wanted to go through this is because we do need to understand put-call parity. And I will expound on that on Monday. Okay? Everybody cool with that? When the meme stocks were going nuts, guys, AMC and GME and all those meme stocks, they were hard to borrow. If you wanted to sell the stock, you could, but with a massive premium. So the alternative to selling the stock is buying the puts. Well, if you went in to buy puts, what happened? The puts were way, way more expensive than the calls were. Because of that relationship to the interest that your brokerage firm was going to charge you to get that stock. All right, everybody. It's Friday. I know everybody wants to get out of here. Oh, good. We got a lot on the wheel here. I love it. I love it. And you know what? I'm in a good mood today. I'm in a good mood every day, but it's Friday. It's been a really good week. We're going to spin twice today. We're going to have two winners today. Okay, you know what sometimes Taco Tuesday, it's a 2 for Tuesday. I know a lot of radio stations will play two songs from the same artist, 2 for Tuesday. So we're going to do two spins on the wheel today. First one, here we go. Here we go, our fantastic Friday, Barry. There we go. This is a brand new person to the live stream. I have not seen M. Alexander Brown here before. So you are a winner. M. Alexander Brown, congratulations. Please send me an email right here to prosperswag@prospertrading.com with your name, your mailing address, and the size swag. So that's winner number one. Let's get another one here. I'm going to take you out of the wheel since you already won today. And let's give it another whirl. Winner number two today is... No way, Zora, come on. Zora, you've won like 15 times already. So you know what? That's okay. We've got swag for everybody. Let's go one more time. We got to spread the wealth. We got to spread the wealth. Here we go. And this is Frank or Robert. It is Robert. Triple threat. Triple threat Friday. Exactly. It's like winning the Triple Crown, right? Batting average, RBIs, home runs. All right, 3 winners today. You guys all have the email address. Email me with your name, mailing address, and size. Okay? Yeah, we'll always try and send out. If I know you've won in the past, I will always ask you what you have, and we will always try and send you out something new. All right, everybody. Again, we'll do a continuation on Monday with this. Hit that like button, smash that like button. Let everybody... Oh, thanks, John. Let everybody know about this. Appreciate you guys. Have a fantastic weekend. See you Monday, everybody.